The game is rigged, and on December 1st, 2025, the people who rig it change the rules. This wasn't a headline. It was a calculated power move, executed behind closed doors to punish one group of investors and reward another. For the last 2.5 years, you've been fighting an invisible force pulling your money down. That force has just been reversed, and it was replaced with something else entirely. Today, I'm showing you the mechanics of that move. You're about to see the hidden mechanism that was just activated, who stands to gain from it, who pays the price, and why the timing was critical. This isn't a forecast. This is a debriefing. To understand the move they just made, you first have to recognize the force you've been fighting. Since mid-2022, it has felt like swimming against a brutal riptide. Every time the market tried to move up, an invisible wall seemed to slam it back down. That wasn't a feeling. It was a machine. It was designed for one purpose: to methodically pull liquidity out of the financial system. Imagine the market is a harbor and your assets are the boats. This machine was engineered to open the floodgates and drain the water out. The scale of this operation was immense. It created a $2.4 trillion headwind aimed at the market, one of the most aggressive liquidity drains in history. And it was working until it triggered a warning that forced their hand. Understanding that warning is the key to this entire story. So what prompted the reversal? Here's the part most people miss. They had tried draining the system once before, back in 2019, and they went too far. They pulled out too much liquidity, and the entire plumbing of the financial system seized up. The overnight markets where banks lend to each other froze, and the Fed had to emergency inject hundreds of billions of dollars to keep the system from collapsing. They were determined not to make that mistake again. Throughout 2024 and 2025, they watched the warning lights flash. Bank reserves were dropping toward the same critical levels that preceded the 2019 crisis. So before the system could fracture again, they acted. On December 1st, 2025, they hit the brake and began reversing the machine. But here's the power move. They didn't just stop the drain. They quietly began to refill the system. They will give this a boring name to make you ignore it. But the name doesn't matter. What matters is where the money flows now. And that defines the new map for capital. When a multi-trillion-dollar flow of money reverses course, it doesn't spread out evenly. It finds a new home in stages. If you understand the likely path, you can anticipate the pressure points. The first wave is often about relief. The money moves toward the assets that were most starved of capital. Think about the companies that have been choked for years. This is where the handcuffs come off. We're talking about small cap and growth stocks, which are now positioned for a potential tailwind. This first wave then tends to flood sectors left for dead, industries like real estate and utilities, whose business models were being strangled by high borrowing costs. As that pressure lifts, their projects can become more profitable and their dividends more attractive. But after that first wave of relief, a second, more powerful wave often builds. This is where ambition and speculation can take over. This move wasn't just about stocks. It was about preventing a systemic problem in the credit markets. The biggest fear on Wall Street was a corporate credit crisis. With this liquidity shift, that danger has been significantly reduced. The financial plumbing is unclogged. With that fear receding, speculative energy comes off the sidelines. And where does it often go? The ultimate canary in the liquidity coal mine, cryptocurrencies. Whether you love them or hate them, assets like Bitcoin are a proxy for global liquidity. When the drain was on, crypto was crushed. Now that the flow has reversed, that speculative energy looks for a home. Finally, there's the smart money's classic hedge, gold. A direct consequence of this policy shift is downward pressure on the US dollar. When market participants start to question the near-term trajectory of fiat money, they don't just run to cash. They often look to gold. Each of these waves creates a new group of winners, but it also leaves someone else holding the bag. This financial shift isn't a miracle. It's a transfer. And a bill comes due for those who don't reposition for the new environment. First, anyone holding excess cash. For the last 2 years, holding cash was a rewarded strategy. That regime is now changing. The calculus for safe money has inverted. Every day that capital stays on the sidelines, it risks not just a loss of purchasing power, but also subsidizing the gains of others. The second group is investors in long-duration government bonds. The brief era of a 5% risk-free return is likely behind us. As yields fall, that capital is forcibly pushed out on the risk curve, often into the very assets we just covered. Finally, the US dollar itself is being used to facilitate this. The Fed has signaled that its aggressive dollar strengthening policy is entering a new phase. Capital that was hiding in the dollar is now looking for a new home, putting the currency in the crosshairs. This power move is happening now, and the mainstream will likely report on it long after the initial shifts are made. To stay ahead of the hidden forces shaping your money, make sure you subscribe. I break down one of these moves every week. Now, drop a comment below. Which asset do you think will be the biggest target for this new wave of capital? Let's be clear. The Fed will never call this QE5. They will insist it's a technical adjustment, or use a deliberately boring name. But we can see what it is. A calculated decision to stop the pressure and reinflate the assets they can't afford to let fail. They didn't just stop the drain, they flipped the switch. The multi-trillion-dollar headwind has become a tailwind. For years, the game was defense. Now it shifts toward offense. The rules have changed. The people who benefit first in these moments aren't the luckiest. They're the ones who see the move being made and reposition accordingly. The time for hiding in cash is ending. The window is open. But a move this large is never clean. And the question now is whether they can control the second-order effects.